Hello, two topics today. The first one will be to compare the chart of Fed fund rates with the S&P 500. So when we will see what usually happens when Fed funds start to rise. Then I will discuss the lower correlation we see between European stock markets. First topic, correlation between Fed fund rates and the S&P 500. So the black line is the Fed fund rates, and the green line is the S&P 500. So what we can see here is that usually when Fed fund rates are going up, this is not really good news for the S&P 500, not in the short term, because usually what happens is that the market continues to rise when the Fed starts to increase rates. Which is pretty logical because the Fed is raising rates when the economy is strong. But usually this is the end that we're in the last wave of the bull market. So here, since the mid 1980s, we have seen 1, 2, 3, 4, and this is the fifth period with Fed fund rates rising. In what happened in the past, so as you can see in the late 1980s, Fed fund rate hike triggered the 1987 crash. So we can see very clearly the correlation between the Fed starting to tighten monetary policy and the stock market crash. In mid 1990, we saw a bear market in 1994 coinciding with a sharp rise of Fed fund targets. In the late 1990s, a persistently bull market because of the TMT bubble, the Fed raised rates pretty aggressively. Then we had this bear market in 2001, 2002. The last period was the sharp rise of Fed fund target rates in 2004, 2005 in the aftermath of the TMT bubble. So once again, the Fed was quite aggressive, then started to pause, and this is when we had the credit bubble. Then it bursted in, as you know, in 2008, 2009. So today is quite a challenging period for the Fed. We can see that they are very cautious in raising rates after a significant period of rates close to zero, which triggered obviously a very, very strong bull market on the S&P 500. So the biggest challenge for the Fed next year will be to keep these bull markets alive. Because the bull market is entering its 9th year, which is the longest bull market since the late 1990s. So between, no, this is even between 1991 and 1999, so 9 years. So the challenge for the next year will be to avoid triggering a stock market crash. And also avoid fooling this equity bubble, because I think that we are now in an equity bubble. So this is a very, very challenging period for the new Fed chairman that will be nominated in 1 or 2 weeks, probably next week. And I think I'm feeling a bit nervous when I look at this chart, because if the Fed will delay rate rise, it means that the bubble will get bigger, and the risk of having a crash next year, because I think the only way to end this bubble will be a stock market crash next year. Or the alternative will be to raise rates, to keep raising rates pretty aggressively right now, which in the short term, of course, will not be very good news for the stock market, or will at least trigger a higher level of volatility. So the second topic I would like to discuss with you is the decorrelation we have started to see since August between European stock markets. So very strong core European stock markets, DAX 30, CAC 40, also so it's the Netherlands, which have been pretty strong. And on the other hand, we have started to see a significant correction of the Greek stock market, so the FTSE ASE, and also, of course, the IBEX 35 index, knowing that the Italian stock market, which has been much stronger than Spanish and Greek ones, is also starting to underperform core European stock markets, with the FTSE MIB underperforming since August. So this decorrelation is showing that there is something wrong happening in the Eurozone. So of course the market is getting worried about Spain, about what's happening in the Catalan region. I don't see this as very good news. It shows that we have started to see a flight to safe countries. Safe. I'm not sure that they will be safe, because if we have troubles in Spain, it will probably have a negative impact on France and Germany. But anyway, the market feels safer buying German and French stocks, and is dumping quite aggressively Spanish, Greek stocks, and even now Italian stocks. So that's something quite worrying, because it shows that the level of confidence toward the Eurozone is slightly declining. And in parallel, I would recommend to monitor the euro dollar, which may be forming since a couple of weeks, head and shoulder pattern. Thank you for listening, and have a good week.